Okay guys, so in today's video, I'll be talking to you guys about the COT report. This is an amazing report that allows hedge fund managers, asset managers, retail traders, and anyone investing in the markets to see how the professional markets are positioned to be buying or selling a currency in the Forex markets. So you can literally see how many contracts there are to buy, for an example, in this video, the Aussie dollar, or to sell the Aussie dollar. And in this Excel spreadsheet, which you can update every single week when the COT report data comes out, you will literally see week by week how much the data is changing and how positioned the market is committed to buying or selling a currency. So it's really important for you to be on the right side of the markets, know how the professionals are investing, and I'm going to show you something called the flip, when the amount of long contracts and short contracts to either buy or sell a currency flips from being positive to negative or negative to positive, so you can get into a currency pair trend at the beginning. And this is what the COT report can be used for when you're investing in currencies. So guys, I hope you enjoyed this video. Please like, comment, subscribe. Let me know if you've been using this COT report and if you was understanding how to interpret it the way I'm going to show you in this video. And hopefully I'll be trading with you soon. Thank you. Okay guys, welcome. Got some really advanced strategies for trading the markets that you're going to be learning in this video. I'm going to be showing you how to access data that shows you how positioned hedge funds and asset managers are in the Forex markets, so you can understand how to position your trades alongside the professional markets. Now, I came across an article on Bloomberg today, and it was talking about hedge funds and asset managers have ratcheted up short positions against the risk-sensitive Australian dollar. Okay, so why are they so short the Australian currency in the Forex markets? Well, it's all to do with a global economic slowdown that is expected. And the Aussie dollar is seen as a risk currency. And a risk currency is any currency that has a high volatility and is down to their exports being mainly based around commodities. Okay, so Australia's key commodity export is iron ore, makes up 31%. The next commodity export is coal and petroleum gas. So a lot of Australia's wealth comes from commodities that they're selling to the rest of the world. As you can clearly see, it makes up a large proportion of their exports. Okay, where are they selling those exports to? Well, if you click on iron ore, you can see 80% of iron ore's exports is going to China. Okay, and we know China's going through an economic slowdown right now because of the property crisis that they're going through at this moment in time. So if I'm going to show you every time the iron ore price plummets, you're going to see the Australian dollar plummet at exactly the same time. Because if you need to understand an exchange rate, if you're looking at the Aussie dollar against the US dollar, the currency pair exchange rate value is based on rest of world reserves of one currency compared to rest of world reserves of another country, compared as a ratio. So just like your bank account, you have a balance of payments, you have money that comes into your bank account, you have money that goes out of your bank account, and then you have a final balance, either being in credit or in debit. Okay, and it's the same for a country. They call this the current account balance. And if a country's key export, like Australia, if the value of that export goes up in value, a lot more money comes into the country than goes out of the country. So that means the rest of world reserves of Aussie dollars are decreasing relative to a country like the United States, which is not dependent on commodity exports. So that essentially means less Aussie dollars have to buy US dollars in exchange when you compare the total amount as a ratio. Obviously the numbers get really big because we're talking trillions of dollars, but that is literally how an exchange rate is valued. So if I show you iron ore accounts for 31%, in this spreadsheet here, I'm going to show you how we can look at the Australian economy. This is what I teach on my advanced course. It might seem like a lot of data, but if you scroll across to the commodity section, because this is what's important for Australia, I'm going to show you the iron ore price highlighted in red and the Aussie dollar, US dollar highlighted in green. Now, straight away, you can see the correlation between the exchange rate and the price of iron ore. Now, the reason behind this is because iron ore is created to make steel. Okay, steel is used for construction, building bridges. It's used during times of economic growth. So when there's economic growth around the world, there is an uptick in the demand for iron ore because countries are going through big development. Okay, it's times of prosperity, and you see the iron ore price go up in value, and that causes more money to come into Australia relative to how much money is going out to pay for their imports, and that causes rest of world reserve to decrease, and you see the Aussie dollar go up in value against the US dollar. And then during a recession, which is what the article here is talking about, hedge funds looking at a global economic slowdown, what happens? Development slows down, the iron ore price drops, the demand falls for iron ore, and as soon as the price of iron ore plummets, look what happens to the Aussie dollar against the US dollar. It goes down in value. As soon as an economic recovery comes back, which we saw coming out of 2008 from 2009, you see the iron ore price rising again. No surprise, the Aussie dollar, US dollar goes up in value with it. And you can see it goes and it follows each other in history. And you've had another episode again in recent times since February and March 2020 during COVID. We had a big boom in commodities. After that period, we had a big boom in the Aussie dollar, and now the commodities have started to come down again. No surprise, Aussie dollar, US dollar has started to come down again. Okay, so you can see that correlation, and that has been playing out if you look on a chart here in the currency markets. Okay, so if I show you the last 3 recessions, we had a recession in 2020. Look how much the Aussie dollar lost its value against the US dollar, 21%. If we go back to the last recession, which was all the way back in 2008, it lost 40% of its value. And the recession before that, in 2000, when the dot-com bubble happened, it lost 28% of its value during that period. So if I take you back 22 years since 2000, you can see there's been a big decline in the Aussie dollar every time there's a recession. And that's because the iron ore price falls in value every single time. So now that you understand that in the markets, which is the key, because commodity currencies are the most volatile because of this risk of their commodities going down in value very rapidly. Now you understand this, I'm going to show you how there's a thing called the COT report. Now the COT report is basically a report that tells you how positioned hedge funds are in the markets for a currency. And you can look at this across the currency markets. So you come over to the COT report website, you click on this section here to get the data in Excel, and it will come up with all this data here. Okay, and in this spreadsheet, which I have for all of my course members, I teach them how to, in this final section over here, download the data, select the certain columns, and then build this spreadsheet out. But what I want to show you is how do you interpret the spreadsheet. So what it does, it takes all of the non-commercial positions in currencies. So what is commercial and non-commercial? Commercial positions in the market is for like businesses that need to expose their currency risk if they're trading around the world. So a lot of businesses that are doing business all around the world, they will get involved in the Forex market, not for speculative terms to make a profit, but to protect their business. So they may buy contracts of a certain currency to make sure that if that currency goes up or down in value, it doesn't affect how much they're selling their key commodity for, as an example. Okay, but non-commercial trading, which is what we're looking at here, is literally telling you how many long positions are there for a currency and how many short positions are there for a currency, so you can know if the market is overall selling a currency or buying a currency. That is why in this article over here, you can see it says hedge funds have ratcheted up short positions to 61,000 contracts. Okay, so it takes all the contracts in the futures market where they're betting on the future price of the Aussie dollar. You have all of the leveraged long positions, you have all of the short positions, and then you have the change, which is the difference between the long positions, difference between the short positions, and then the percentage of these long and short positions. But most importantly, what it is doing is it's taking the total amount and is calculating, is the total amount of contracts positive for buying a currency or negative for selling a currency. And if I show you on this chart here, you will see that 0 represents contracts being flat, so it's not positive or negative. Below 0 is negative contracts, above 0 is positive contracts for the Aussie dollar. Are investment banks, hedge fund managers, asset managers, are they buying the currency or are they selling the currency? Okay, and then I have on top of that, you can see that's the flip data highlighted in the brown line on the chart, and then the Aussie dollar, US dollar is highlighted in the green. Now, you can see a very strong correlation between the COT report data going down and going up and the currency pair going up and going down, because professional traders are using this data to know what all the other investment banks and all the other hedge funds are doing, so they can make sure that they're positioned in a currency at the right times. So how the flip data works, once you have, on the course I'll be showing you how to get all the data, once you have downloaded all the data, put it into your spreadsheet and updated the latest reading, you're going to get a certain amount of either long contracts or short contracts. Anything below zero, they're selling the currency pair. Anything above zero, they're buying the currency pair, okay? And then you have peaks and troughs where the markets are very extendedly bullish on a currency or very bearish on a currency. Anything above 60, you can see that it never gets above 60. And this data is going back to 2004. So every time it goes up to these levels here, you can kind of see that the currency pair, well, it can never go above 60 because it's really when the economy for Australia has reached its peak and maybe interest rates have gone up, and obviously at the same time the commodities have reached their peak, because an economy can only grow so far before we have recessions. That's just the economic cycle we go through. So how you interpret this data is this: when the brown line has gone above or below the zero bound, that is when the contracts either flip from being negative to positive, or they flip from being positive to negative. And it's during the flip that you know that the markets have either turned bullish on a currency or bearish on a currency. If they've gone into negative territory, this is the time when hedge funds know to sell the currency, because it's gone from being bullish a currency and now they're bearish. And that's when, if all the fundamentals line up, which is what we do in our spreadsheets over here, when we're looking at a country, we're tracking what's happening with inflation, what's happening with interest rates, what's happening with all the leading economic indicators, which are predicting what's happening with the iron ore price, so on and so forth. Once we get the green lights to know whether we want to be taking a long or short position in the currency, we come over to the COT report and we want a confirmation. Is the rest of the markets net long or net short? And if they flip from being long to short, then you know the sentiment has now changed into a bear market for the Aussie dollar, as an example. And you can see here, as soon as it went below the zero bound, look at the exchange rate, immediately have a nasty sell-off. Why is that? Because investors are looking at this data. Look what happened over here. The moment it went above zero, the exchange rate took off at exactly the same time, because all the hedge funds, all the investment banks, all the professional markets are looking at this data, and they know what that means, because they know all the other professionals are doing this at the same time, because these businesses have to declare their positions, okay, legally. So now you can understand why you have this data available for investors. So you can see here, every time they move alongside each other, it's a beautiful correlation. So what you want to do is, when you're looking at this data, which is what I teach, you don't want to be buying at the extremes, because this is where the data usually flips and goes in the opposite direction. As you can clearly see, going back to 2004, you don't get the data going below 30, minus 30, and you don't get the data going above 60. So there's a reason for this. It's because it reaches its peak when a currency pair is overbought or a currency pair is oversold. And this is looking at the Aussie dollar net long or net short positions, and we're looking at it against the US dollar. Why the US dollar? Because the US dollar is the world's reserve currency. So that's how you have to price the Aussie dollar in terms of sentiment. Okay, so at the moment, you see here when it says investors are extremely negative in the positions, well, there you have it. You can see the green line is confirming this, and the Aussie dollar is going lower against the US dollar. Now remember, inflation in the US, if I take you over to the US section of the spreadsheet, very high, 9.1%, okay? And we know the central bank is raising interest rates aggressively at this moment. It's the next one in September is going from 2.5% to 3%, probably 75 basis points, maybe going to go up to 3.25% or 3.5%. They're saying it could go up to 4% by the end of the year. And historically, every time a central bank has in history had to fight inflation, they always tip the global economy into a recession. And if the US is the world's biggest economy, it tips the whole world into a recession. That's why you are hearing investment banks talking about their expectation of an economic slowdown, because the Fed is hiking rates. So you see how they say this, guys? This is what is going to happen. Look, it says it here. It is not the environment for the Aussie dollar to perform, because it's going to have an effect on the rest of the world reserves, because their commodities are going to get hit by the slowdown. Okay, guys, so this is something I teach on my course. You can see here, we have all the videos on my Forex trading course. This is all macroeconomics, understanding the fundamentals. If you've been training technical analysis, chart patterns, and you're understanding why you're not making some money, or why you're being very inconsistent because you haven't been exposed to this level of knowledge of really getting into the fundamentals of market movements, then you use technicals to time your fundamental trade ideas alongside risk management. So you can get this spreadsheet, guys, and my whole currency course And alongside all my other courses, I've got a commodities course, crypto course. We have a stock market course as well. So you'll have 4 courses, and it's only £100 a month, full access to all of the courses. Not expensive. It's more affordable for everyone to get their hands on, so you can come along and get this, and then you'll get Telegram access as well for me to be sharing with you guys video updates on markets, sharing with you some of my trade ideas, telling you what's happening in the markets throughout the trading day, so you can come and trade alongside me as you learn, as I'm here to mentor you, okay? Live training session links I give to members, videos of me personally telling you what's going on in the markets, so on and so forth. So guys, look, I hope that made sense. Thank you for watching. Please like, comment, subscribe, and tell me if this video helped you. And hopefully guys, I will speak to you very shortly. Thank you. Okay guys, so I really hope you enjoyed that video. We looked at the COT report for the Australian dollar, but in that spreadsheet, you have all the currencies covered. So there's data for the pound, the euro, the yen, the Swiss franc, Aussie dollar, New Zealand dollar, Norwegian krona, Canadian dollar, Russian ruble, South African rand. Every currency is covered in that spreadsheet, and it comes out every Friday. Okay, and now I have another video to show you how you can track some economic data in the United States that tells you if the US is going to go through growth or contraction, because we know that's going to have a big impact on what happens on the iron ore price. And this one data release will literally predicts iron ore prices with an incredible amount of certainty, and it also predicts the price of crude oil. So click on this video, watch this next video, and it'll make a lot more sense of how you can build up your analysis and understanding of using fundamentals when you're trading the currency markets. All right, guys, enjoy the video.